Alex, my friend, how are you?
I'm doing great, man. Gorgeous day outside and excited to see you.
It is a beautiful sunny day out there.
We should be sitting outside. You and I were talking about this earlier. We should be
Right.
recording outside right now.
When it's nice weather, we're gonna have to do like Alex and Tom around town and record outside.
Yes, let's do that. From now on, we only record videos in new restaurants. Um,
Right.
we should do that. So, Tom, last week you and I were chatting a little bit. I am armed with a bunch of slides that are fresh from family reunion. I know you've had a quick chance to kind of peek at them for a little bit, but what would you say to just running through kind of some of the major ones that we got from family reunion as far as some statistics are concerned?
Yeah, so definitely we should take advantage of what you found out going out in Vegas, and we should kind of research that out for everybody. I think we're gonna find some data that's a little illuminating and some that reinforces things that we said, so I think it'll be a good thing to go through all of them.
I like it. All right, so let me grab these slides real quick, and then we shall. How should we do this? We shall do it this way. Sure. All right, cool. So a couple things that we're going to run through real quick. Let me give you the title slide. Where are we right here? So 7 major areas that hopefully we could just cover really, really quickly. And Tom, I'm gonna be pushing us here a little bit. I don't want to spend more than like 30 seconds to a minute on each one, so that we keep the video under 10 minutes. So I'm going to rush you a little
Keep us
bit.
moving, keep us moving.
So we'll talk about home sales, home prices, total market volume, inventory, mortgage rates, treasury spread, and affordability. So first one that we saw were home sales and kind of what things have been doing here. Any things pop out to you just top of mind, Tom, that you saw looking at this thing?
So two things is one, the first part, I think reinforces something that we knew that 23 was less of a year than 21 and 22 were there, right?
Yeah.
Um, but then also like extrapolating, it looks like 24 is going to have a little bit of a rebound effect there.
Yeah, for sure. I mean, one of the things that I was just noting, like, I don't think this is any surprise, right? 19, we're kind of rolling along. I would kind of highlight the fact that from let's say 2013 through 2019, even into 2020, you're hovering in and around that kind of five and a half number, right? That actually represents millions, 5.5 million home sales in America. Then all of
Sure.
a sudden you get to 2020, that climbs to the highest level that we've seen in a while. And then 2021 just went absolutely nuts. So 22, we saw a reversion back to the mean. We saw those sales come down quite considerably. And then 2023 is the lowest it's been since 2008, right? That is the pressure we've been feeling. Now that we're here, now that interest rates are going back up, the word on the street is that we would likely see a little bit more sales go up this year, as far as what the rest of this year looks like. Here's another chart to show this to us. How do I get out of this annotation button? Here we go. Another one to kind of represent this in a different way. This is 2022 versus 2023. No surprise here. Same thing that we're seeing. I guess I got to erase this.
Right. So this one doesn't do any projections for us for 2024. So to me, again, it's really recapping data that you and I have hit before.
Right.
Um, and showing that, 23, how we basically got to that a little bit of a down year, right?
Yeah. And this slide specifically is showing seasonality a little bit. You can see in 2022, there was a steady decline as far as sales were moving. And then in 2023, that was kind of steady. Like there was still a decline, but it wasn't as extreme. So we've been feeling that kind of explains, where we've been for the past year. So let's shift a little bit. That's home sales. Let's talk about home prices. This is an important slide. And Tom, I'll let you go first, man. Any big takeaways from this one? What do you see here?
A couple like easy things. These are no surprise. So one, I feel like you guys have used a slide like this a lot in your office. I've seen similar things like this where you're doing that average price curve and we're saying like, yes, there are down years, but year over year, when you average this all out, you have a nice curve going up like that. So the one thing that stands out is you see that curve, and I've seen this in your office, um, a few times. Again, you see the price going up, 23 to 24, even though we have the interest rates where we've seen the interest rates, this last batch of time, right? Since the pandemic, we still see the annual median price going up in on this chart.
Yeah, for sure. One of the things that I would highlight too is the big question here is always like, Okay, and let me explain it this way. We always revert back to the mean, right? So if you have a trend line and we've been operating above that trend line, then historically what we would expect is to see us revert back to that trend line, right? So if we're above it, to come down, if we're below it, to go up. We can see that here. That happened during the crash, right? Those crash years. I don't know how to change this to a different color. Oh, here we go. Do green. We could see that throughout the crash in 07, 08 and everything else like that. You know, we were on our way up. We're 24% above trend. And by the time we get to 2009, we've corrected down underneath of that trend line. Here we are back in 2021, all the way through the past couple of years. And then boom, we get back up to that trend line, but now we go massively above trend, 9.3% above. So the question is, do we drop below that trend line in order to see us revert back to a, you know, a balanced market again, as far as home prices are concerned? Or have we walked through a season that now maybe has reset the trend line a little bit? Okay. That's the big question that everybody's kind of asking right now. And, you know, no one has a magic 8 ball, but if I had to put, you know, my bet in one of the corners, I would say, you know, expect to see home price appreciation slow down considerably until we kind of get back toward that trend line, or at least closer to it. What do you think, Tom?
I think the one thing though is this chart's showing that we're not there yet, right? Because we're still going up from the 390 to 398 from 23 to 24.
Projected,
Right.
yeah.
And I do think that there are things that are different. While we can see a revision back, right? I don't know if we'll see it as hard as what we saw in that 08, 09, right? Times are different. We talk about back then, that was the subprime era and things like that. Now there's like a lot of rules in place that seem to have built-in protections of how bad we can drop off. So while there can be a price correction, I don't know if it'll be as extreme as what we saw back then.
I agree. I would not be expecting the same kind of crash we saw, you know, but just a slow kind of glide back down to, you know, the mean, if you will. Here's
Right,
another,
like back down to the line, but maybe not necessarily dip so far below.
right, right, exactly. Here are home prices again. This is annual appreciation, so this will give us a little bit more of an idea, just kind of what this looks like from a different way. Again, so here's the crash, right? And then here's pandemic.
And look at those pandemic numbers, man, 12.5%.
Yep. It is the biggest appreciation in home prices we've seen in a very, very long time, 30 years, really. And then here we are in 2023 and 2024. You can see the appreciation in 2023 was less than 1%, right? So prices skyrocketed so high that, and once interest rates came back up, now there's pressure to not have those prices continue to climb any further. 2024, they're expecting 2.2. I was in the room with Gary Keller, and he was saying that that's generous to say that. But I don't know if we get to 2.2. The average is 4%, right? That's usually what we're looking for. And I would say that maybe 2 is probably more appropriate. And again, this is likely to be there until we kind of reset to that trend. I'm breaking my own rule, Tom. I said I was going to not talk a lot, and here I am talking a lot.
Well, I mean, we're gonna get to a rate sheet, so I don't want to jump ahead, but I think some of this is like the rate indicators on there, right? Like we think 24 will be a better year than 23 on rates, so we can see that volume going up a little bit. But we don't think 24 is going to drop back down, and again, there's going to be a slide. So I don't want to steal the thunder, but we're not going to have 3-4% rates like that, so it's not going to do this incredible shot up, right?
Right, exactly. Here's another one talking about prices and appreciation. This is kind of a historical chart to show some big events that were happening that helped cause major economic moves. No surprise here, some of the things that we would expect. You can kind of track, though, like history tends to repeat itself. You know what I mean? What's the old saying, Tom? It's like history doesn't repeat, but it sure does rhyme. Is that how it goes?
I don't want to bring up another company, but I worked for a company that said real estate 17-year cycles, and that's sort of what you see there a little bit.
Interesting. Okay, very cool. All right, let's talk about total market volume here. So this is somewhat of a confusing chart, and there's total market volume that's being represented in the trillions, right, for the US market volume. Then there's also this blue line that's traveling along, and that's the actual agent count. with volume. And one of the things that you'll notice is that the pattern tends to follow, right? The more volume there is in the real estate market, the more real estate agents there are, right? Makes sense. Hey, there's a lot of stuff selling over here. You can make a lot of money, go get your real estate license and jump into the market. And then as things kind of correct, so do the number of real estate agents and the would-be players, if you will. That's why we try to train agents. Well, what do you think, Tom? What do you see?
I will be the first to admit that when I first saw this chart, that this one confused me.
Sure.
So it has the 3 different data points. I'm like, wait, which data points are we aligning with which line? So I'm not too proud to say that, yeah, this one threw me a little bit.
I like it. Cool. So, I mean, some of the things that you're seeing as far as total market volume, this is a representation of how much housing there is to volume, how much volume there is to be able to sell in the US, right? So here's the trend line. You're looking in and around, oh, that's not a trend line, forgive me. That's just what 2023 was. You'll notice there's a lot of volume. There's way more volume that we've had. And 2023 may actually be the floor for what we would see, maybe inside of a 5 to 7 year cycle, right? So 2021 was at 1.87 trillion, and then 2023 is 2.09 trillion. We do expect that to go up slightly. How much we're not entirely sure, but again, the amount of volume from 2021 to 2022 down to 2023 has corrected right here.
Right, and it does look like there's still more room for the agent count to pull back.
Correct. Yes. Actually, that I'm glad that you said that, Tom, because we've been talking about this a lot.
We brought it up a few times before, but I think this kind of shows it. If you look back at the historical time and where the agent count was, and look how high the agent count got for the, it's not represented with the volume amount, right?
Correct. Yep. One of the things that really stand out to me, so from 2007 to 2008, we lost about 140,000 agents. And over the next couple of years, I know that from the height in, I think it was 06, yeah, well, according to this chart, it's 06. The height in 06 down to like 2010 to 2011, there was something like 300,000 agents that had left the business. And the word on the street right now with NAR and even at KW and different places is that we are expecting to lose about 50% of somewhere between 35 to 50% of agents in 2024 of all licensed agents. And so for those that are more experienced, that's kind of a good thing because things are loosening up a little bit. We'll, you know, we might see some more things come to the market. We might see interest rates maybe relax slightly. But if things loosen up, there should be more business available for a smaller amount of agents. That would be a good thing. That's
a big number, they said.
Yeah, I mean, that's a huge number. And everybody's been throwing that out. I'm curious to see if that becomes a reality or not. Another one here. Same thing. This is adjusted for inflation. Okay. I don't think we need to go through
the same numbers, right?
Yep. All right, here's inventory. This is what we're feeling inside of the industry. These are the things that have really affected our business because we were talking about volume, all that looks good. Now we're looking at inventory, and this is where the real challenge is, right? We're obviously well below the balanced market of a 6 month, you know, we talk about it in months of inventory, right? So we're well
your 6 month supply, right?
Mm-hmm. Lowest we've had was in 2021, and we have seen that go up, and I would expect that it continues to climb slightly.
Okay.
Yeah. All right. Your slide, my friend. Talk to us about mortgage rates.
I think we're going to see this on a couple different slides, but it's a lot of what we talk about on a week-to-week basis when we say the interest rates. I think it was maybe 2 weeks ago we talked about the big drop in rates, and there's going to be a monthly one that follows this. But the big drop in rates, how we started 2024 in the 6.6s, but in just a few months earlier at the end of 2023, we were up at the 7s. So you kind of see that there with the drop late in 2023 to the 6.81. Today, just to sneak that number in, today we're at 6.74 is the average rate.
Okay.
But if you could go to the next one, I believe, if that's okay.
Yeah. Of course. Sorry, I'm drawing fun stuff on the mortgage rates. There we go.
All right, so this is what I mean. So October 2023, right? You have the 7.6. we saw the decrease down to the 6.6 in January 2024. And then 2 weeks ago, I think we did a report on how the January and February sales numbers, which obviously reflect more contracts written in December and January, right? But as the rates dropped, how the numbers actually jumped up.
Yeah.
So if we can see this trend line continue to go this way, I think that backs up what we've seen on the other grids about hopefully the volume increasing in 2024 over the 2023. So to me, it's just a correlation on this grid with that.
Yeah, yeah, I agree. It was funny. I'm kind of drawing on the sheet now. I don't know if you can see that. I actually matched that color really well. But we did see that. Can you not see it? It's fun. Can you see what I'm drawing on this, or otherwise am I just talking to myself? So we kind of did one of these things.
All right, there, green, yeah.
Yeah. So I drew it in orange. It was the same color. But anyway, we saw this kind of happen a little bit where we climbed back up. I'm just trying to illustrate what it is that you're kind of talking us through there a little bit. And then the word on the street, right? We've all been talking about lower interest rates, but now it's like, all right, well, are they actually going to lower them? We might see 25 basis points total all year. You know what I mean? Is the latest I heard. I don't know if you've gotten any more recent information.
There's still, it's all betting, it seems like, right? This is like legalized gambling. But the betting money this week is on a June rate decrease.
Okay.
Right. So it is interesting. We talked about this a little bit in 2023. We thought more, Aprilish for a drop in rates from the Fed. And so to your point, in seeing less in 2024 than maybe we thought it would be, it has pushed out to where odds are now more a June decrease. So a couple months later than what maybe we would have said last year, right?
Yeah.
But when we push that out a couple months, then that pushes back how many rate decreases we can have. And that's why, to your point, you're saying maybe there's going to be less rate decreases this year than previously we might have thought.
Right. This is a really interesting slide too, this treasury spread. So I know I'm kind of throwing this one at you, Tom. Can you explain a little bit what the treasury spread is and how that affects mortgage rates?
So mortgage rates, obviously, in a weird way, they work opposite of the general stock market, right? Because mortgage is based in bonds versus like stocks, and bonds are usually a little less radical, right?
Mm-hmm.
So where we say stock market kind of roller coaster and things like that. So the correlation with the bonds and the treasury spread, or what's interesting to me on this thing, is that this did kind of roller coaster. We see some spikes and some decreases. Obviously, we're in a big spike there on the right-hand side as you look at the Q4 2023. That big spike like that. This should be more of a safe haven, right? And less curvy.
Right.
Less roller coaster. You should have some things like that. But typically we want to see bonds be safer than the stock market like that, right?
Right.
But to me, the big thing to see is those big swings at the end over there.
Mm-hmm.
As you see the drop, right? As we saw the rates pandemic wise, and then the shoot back up like that. That for a treasury spread is a big curve.
Yeah, huge. And obviously the last time we saw that was over here. One of the things that I learned, Tom, and from an economic standpoint, is just like what you really want typically is something like this a little bit, where you're kind of bumping in and around, like a normalized kind of number. But when you see what we've seen in 08, 09, and then again in 2021 and 2023, these big movements, like this is really what kind of like rocks the boat, so to speak, as far as the economy is concerned. And I think one of the reasons why at the front lines of this industry, it's just like we've all been saying, like, this is the craziest market we've ever seen. Even agents that were there in 08 and 09 saying, like, this is something we've never seen before. I think a lot of that is describing what this chart is showing. Like the US economy over the past 5 years has been crazy. When have you seen interest rates do anything like this, except in a major kind of crash? What that means for the future, nobody knows. But, one of the things Gary Keller said when he was on stage is like, those of us that are inside of the industry need to realize is like, the US economy may not be in a recession, but the housing market is. So operate accordingly, right? the housing market has shifted into its recession cycle, even though the U.S. economy isn't necessarily in a recession itself.
Also, I mean, to me, the chart shows volatility, right? Which is the word that we throw around a lot like this with rates is when you see from the other slide, like 7.7 to 6.6 in a 3-month gap,
Yeah.
basically, right? Like that's a huge swing in rates. Rates are usually more the part that you circled there, that up, down a quarter. You know what I mean?
Yep.
That was a big volatile switch like that. And then when you're talking about the recession, that was on that home sales slide, right? Like we're not growing off the charts, the growing is slowing.
Yeah, for sure. Last one here for us, Tom. And this one makes me really happy, man, because you and I think it was back in January. I forget when we did this, but you and I did a lot of work looking at all of the historical numbers of what things sold for versus interest rates versus median income. And we put all that data together to try to come up with a chart and show that, like, hey, this is why affordability feels so difficult. Well, here's the one that Keller Williams put in front of us. And as I was sitting there in Vegas, I was like, oh, Tom, they did we did all the work to show all
Yeah, I
that.
can't put a date on when we did this, but what you and I did is eerily similar to what this is.
Yep. And we came up with the same conclusions as well. So no surprise here, 1981. This is really, really interesting. In 1981, with interest rates being as high as they were, affordability was brutal because let me explain this real quick. This is principal and interest as a percent of income, right? So your mortgage payment, not including taxes and insurance, made up in 1981, it made up 49% of income, of your take-home income. 2006, it was 1/3, and then here we are again, 2003, it's about 1/3.
Well, when you and I did that 1980s, that 1979, 80, 81 like period, we saw rates in the high teens.
Yeah.
Right. That's
Yeah.
when we were talking about the 15%, the 16%, the whatever, things like that. And then you saw it trend down like this. In 2006, when we had the crash, that's the other one that you circled over there. And then obviously now, just I'm gonna steal your Gary Keller line. I'm gonna call it the like home recession right now that we're going. So you circled those 3 big events like that, but yeah, it was shocking with the percentage of the income, but it makes sense when your rate is 15%, like in the 80s there.
Yeah.
Right. Now rates at 7% like this, and it's still making up this big percentage of our income. And that's where you get into that thing that maybe the economy is not as slow as housing, but these things are taking up a bigger percentage of our income now, is what the concern is, right? Like, and that's where inflation comes in like that. Wages aren't growing at the same pace that our costs are growing.
Right.
Right. So the percentage that these things are taking up of our wages is on this increase.
Right. I'm glad that you said that. That is the key right there. Our wages have not grown at the same level that these payments have. And now the affordability has gone down as a result. We've been looking at this slide a lot, right? So everybody's been talking about this. It's like, well, mortgage rates in the 7s really aren't that high because historically, right? And here's the historical average. The green line from 1990 to 1923 is 5.98. And then the historical average from 72 to 23, so about 40-ish years, is 7.74. And so everybody keeps saying, well, interest rates are not that high. I remember when I bought my house in the 80s at 18%, right? But what that doesn't explain is this. This is the actual felt difference. And historically, in those same time periods, even though the interest rates were the same, the affordability for the past 23 years has been more like 1/5 of take home, not 32%. So you're making up a big gap there as far as a lack of affordability as to what happened in the past couple of years. And this is what people need to understand. Like the housing payment now, it's more expensive to own a home now because of what has happened with inflation and with interest rates. Our wages have not caught up. So that housing payment takes up more of our discretionary income as a result.
Yeah, and that's an amazing jump really for 3 years.
Yeah.
On that chart, right? Like that's just 3 years that's being represented, but it's almost like straight up and down, right? But we've seen rates go up, we've seen the bidding wars that drive the housing prices up. So you have sort of the double duo, right? Of those driving that price up. and the wages haven't kept up like that. So the percentage is being eaten up, and that's what we really feel like. That's real life right there. What we feel of what we have left over,
Yeah.
disposable income.
Yeah. The crazy thing is like this was kind of the most affordable time period, right? In 2012, right at the tail end of what happened with the crash in 07 and 08. And then
that's when the prices were in that low part of that curve,
right.
The prices on that one curve that KW used all the time, home prices were down. Interest rates weren't as low as pandemic time, but they were still low. I would probably venture to say somewhere in there was probably in the 5-ish range, 4.5 range, somewhere in that range, like that. But look at the affordability of it. The combination is great, right?
Yeah. Now, the crazy thing for me is that affordability in 2012 was excellent. And the next time we saw that was in 2020. And it's just the irony of that is crazy. Obviously, we know because of the cost of money, they lowered interest rates. So now all of a sudden, housing's more affordable than it's ever been. And actually, everything was more affordable than it had been for a long time. But the radical correction that's come as a result is that felt difference here. And that's what a lot of people are really struggling with right now. It's difficult to get in a home. And there's especially the timing of this that kind of isn't mentioned in this chart as well, is that millennials have come of age at this exact same time. So typically your go-to home buyers are the generation that's in their 30s, right? Late 20s, early 30s. And so millennials have come of age at almost the exact same time as all of these things were happening. So now you have a massive generational shift as well, where actually last year, millennials, who should be the chief purchasers of real estate, were outpaced by baby boomers, which was crazy. They're being outpaced by their grandparents and their parents, which is
the baby boomers have the equity to sell, right? And the houses that they have and the prices where they're at. And I think you and I touched on it once a month or two ago, like that millennials are percentage wise behind the curve, if you will, versus previous generations in home ownership. Like the percentage of millennials that own homes right now is outpaced by all the previous generations.
Yes. I mean, absolutely. Now, Tom, I promised this was going to be a short video. There's a lot of slides that we went through. I think the whole slide deck's actually 200. There's things on inflation and everything else. This one just caught my eye, which was personal savings rate. One of the comments that came off of the stage, Gary Keller actually said this. He said, if millennials would only save 10% or have a 10% savings rate, it would fix inflation, which is crazy to me. And like the idea that we could fix inflation simply by putting more money in savings is really, really interesting. I'm just browsing through a couple of these slides. I don't want to go through, one of the things I was trying to find was like a slide on equity, but it might take me a little while to go through all these slides. So I'm just gonna, why don't I stop us there? And then, cool. We went through a lot, Tom. Any big takeaways for you? I think I said all mine in the last slide.
Now, well, I want to say thank you for bringing this back from Las Vegas, and I think this is a good refresher for anybody that didn't, maybe make it out for the trip like that.
Yeah.
So I think it's good to hear from the voices like Gary Keller and things like that. But like I said, I wanted to pat ourselves on the back a little bit that some of the things that you and I have said in the last year, right?
Yeah.
Charted out actually in some examples, right? We've charted some of this stuff out. It is being used right here in this slide deck.
Yeah, I love it. It's good stuff. And thanks for being willing to sit down and go through these slides with me too, Tom. I know we like to nerd out sometimes. If you guys are listening along and you made it this far, high five to you as well. Good job. Tom, thanks so much, man. It's always a pleasure. And I'm sure we'll refer back to a few of these as we continue forward in the year. But always a pleasure to connect with you, man. Get outside. Go enjoy that.
I appreciate it, buddy. You have a great weekend.
Thanks, you too. See ya.